All right. There we go. Welcome, everyone. It's wonderful to see you once again. This is Thursday, January 28th. It's hard to believe we're already a month into the new year. And this meeting is now called to order. Bill, would you please lead us in the Pledge of Allegiance?
Cool.
Are you on mute? I know I saw you.
Did you say Bill or Phil?
Bill.
Oh, okay.
Everybody put
Bill
their,
Rohn.
Ready.
Are we ready? Everybody put their hand over their heart and begin. I pledge allegiance
I pledge allegiance to the flag of the
United States
United
of America
and
to the republic for which it stands, one nation,
nation
under God,
under God,
indivisible,
indivisible,
liberty and
liberty and justice
for
for
all.
all.
Oh. Okay, we might need rehearsals. Excuse me 1 second. We have a number of people in the waiting room. I'll just quick admit them. And now, Marcia, if you would share the thought for the day with us.
I would love to do that.
Thank you.
And yesterday I had a meeting, a Zoom meeting, of course, with there were 72 people on the call, and it was with Scherer, who will be the Rotary International President starting in July 1st. And he spoke. The meeting was supposed to be an hour, and it turned into 2 hours, and it was like 1 o'clock in the morning for him. But we talked a lot about peace and peace projects at the meeting yesterday. And he talked about how, which I've heard John Hugo say in the past, about how everything we do promotes peace. And with our 7 areas of focus, well, obviously the first one is promoting peace. But we fight diseases like polio, and that promotes peace. And providing clean water and sanitation and hygiene promotes peace. And of course, saving mothers and children. And education, growing local economies, and of course the environment promotes peace. So everything we do promotes peace as Rotarians. And I just wanted to, I was going back to our little book here, and I found a little prayer that Dr. Myron Taylor had written. And I have to put my glasses on for this. Help us remember today that a person is a success who has lived well, laughed often, and loved much, who has gained the respect of intelligent persons and the love of children, who leaves the world better than one found it, whether by an improved copy, a perfect poem, or a rescued soul, who never lacked appreciation of earth's beauty or failed to express it, and became a person fit to live with. Help us, each of us, to try to be that person today, to be the person we're meant to be. Thank you very much.
Thank you, Marcia. That was
Very
lovely.
nice.
Good, very good.
And our songmeister and soloist, Ed Gall, will share a themed song for today. Ed?
Yes, I am very happy to do this. If we go back in time, this was my favorite song growing up during World War II, which I guess dates myself. And at the time, everyone I knew, all our neighbors, had a mini farm. And does anybody know what the mini farm was called? I'll tell you, it was called a victory garden.
Right.
So we had a victory garden. But anyway, I'm going to sing it. And I tried to tune it into what we're discussing today, and that's buy and sell, which involves bulls and bears. So here I go. Old MacDonald had a farm, E-I-E-I-O. And on his farm he had some gold, E-I-E-I-O. With a bye-bye here and a bye-bye there. Here a bye, there a bye, everywhere a bye-bye. Old MacDonald had a farm, E-I-E-I-O. Old MacDonald had a farm, E-I-E-I-O. And on his farm he had some bears, E-I-E-I-O. With a cell here and a cell there. Here a cell, there a cell, everywhere a cell. Old MacDonald had a farm, E-I-E-I-O. Thank you.
Marcia.
I didn't realize farmers sold bears.
Oh, this is a unique kind of farm.
Oh, yes, that kind of bear. Okay.
Very good.
We're stretching it a little bit.
First, our
Bears
visiting.
and bulls. Okay.
I see our Assistant Governor, Michael Lushing. Michael, thank you for joining us. It's always a pleasure to see you. Am I missing any other Rotarians that I'm not immediately seeing? Okay. And we have two guests that I see. Rachel Jellin, it's lovely to see you again. Thank you for joining us.
Nice
And Belinda, is your name pronounced Mojica? Is that correct?
Yes, Mojica.
Wonderful. Welcome.
Thank
And
you.
for the benefit of everyone else, Rachel, as you probably remember, is Steve Scherer's daughter, and both Rachel and Belinda are members of the Scherer and Bradford law firm. So again, welcome. We're very happy to have you with us. Is there anybody that I have inadvertently overlooked? If I have, welcome. And we have several announcements. Phil Gabriel and I participated in the information session for this year's Pageant of the Arts program that was held on Saturday. As last year, there will be 5 categories of competition, 2 in music, 1 for vocal, 1 for instrumental. Art and speech will have a special theme that is yet to be announced, and there will be a dance competition. As before, each club can sponsor 1 student per category. Eligible participants are high school students and participants in local after-school programs. So they could live somewhere outside of our immediate area, but if they're participating in a dance class or, for example, in this area, then we have the ability to nominate them or at least allow them to compete. The registration deadline for the participants in the district competition is March 17th. The finals take place on April 17th. We don't have all the details yet, but it will mean that we will want to get our judging done within the first 2 weeks of March, for sure. Marcia, I thought I saw your hand. Did you want to say something? Okay, that's fine. So,
Nancy, two quick things.
Please.
I sent an email to both those teachers. I haven't heard back from them yet.
Okay.
And then the second thing is, are we going to try and have a Zoom for each of the contestants? Or are we going to have like one day when we see everyone on Zoom, which means they'd have to all be ready on the same day, and we have to send them a link to hop on, or are we going to how are we going to do? Are we going to do any in-person judging, or is it all going to be by Zoom?
It's all going to be done by Zoom, as I understand it. They are going to be giving us more information. And
Okay,
I think where uni is concerned, the 2 teachers who have been the driving forces, Khalil and Lynn, will be important for giving us guidance about how they would like to hold the judging. So
the other question I have is can they send us a tape of the performance and then we can view it on?
I believe they will have that option. I mean, they will as I understand it, at the district level, they can do Zoom or sending in a tape, I think. So we'll be learning a lot more over the next week or 2 weeks. We'll keep everybody updated.
I'll follow up with them again today,
Right.
probably another email.
By the way, Phil, for your reference, Khalil is going to join in
I
our.
did that once. I said, "You sure?" I am. I said, "No, you're not. You're blasting a little."
Hey guys, everyone mute yourselves, please. Go ahead, Nancy.
It's done. Khalil will be joining in on our February 11th meeting because we're giving him a Paul Harris Award.
Okay.
So we'll and obviously you want to connect with him before then, but at the very least we'll actually see him on screen in the fairly near future. So
Okay.
So everyone, more information will be coming, and Phil is on top of this. I just wanted to bring everyone else up to date. As I mentioned last week, the next district breakfast will be held on Tuesday, this coming Tuesday, February 2nd at 8 o'clock. I believe Dwight described it as virtual scrambled eggs, and it's it's a relevant topic. So it's easy to sign up. Just go to the District 5280 website, and hopefully a lot of us will participate. And Bet Hall has reached out to explore the idea of Rotary volunteers helping out at the vaccination sites. They don't have anything definite in mind yet, but they're asking us if any of our members might be interested in volunteering. So if you are, please feel free to email me or indicate your interest in the chat box, and I will get back to Bet with any names of people who would like to participate. And now, of course, we have a number of members who have been vaccinated, so maybe some of you would like to help out. But again, this is ideas in the very early stages. And Tom Barron is our windmill scribe for today. Thank you, Tom. Tom does so much for this club. We appreciate you stepping up. Dwight has volunteered for next week. We need writers for the rest of February. So please let Gail know if you're available and interested. I also want to make sure to mention, in case some people aren't aware, we record each of our meetings. And then Ron posts the recordings on our website, on YouTube, and I believe on Vimeo also. Is that correct, Ron? So a couple of other things. We just got news shortly before this meeting started that this year's Rotary International Connection will be virtual once again. So that nobody's going to Taipei. It will all be online. And I don't know anything about the agenda yet, just that it will be virtual once again. It will be in June, early June. And I'll share information with you as more becomes available. Also, Terry White asked me to let everybody know that the quarterly statements will be coming out very shortly, and to please follow up with him. And with no further ado, I'd like to bring on our investment moderator and driving force, Stephen Scherer. Steve, over to you.
Thank you, President Nancy. And I must say, this is a remarkable time in investment history. Certainly, even the last couple of days have been dynamic. And so we're looking forward to having ample time to respond to all questions later on. As many of you know, the first Investment Advisors Day was December 14th of 1989, and that's over 31 years ago. Then the Dow was at 2,700, and prime rate was at 10.5%. Today, the Dow is trading above 30,000. Prime is at 3.25. And since that time, fortunes have been made and lost in the stock and bond markets. So let's take a look at the past year. Stocks around the world closed out one of their best years in 2019. And the trend continued until mid-February of 2020. From that point forward, the story of the US economy consisted of three major shocks. First, COVID, then racial unrest, and finally an election that divided the nation. At the beginning of the year, unemployment, this is at the beginning of the year 2020, unemployment was at record lows. And yet, employment kept rising. The longest expansion in US history appeared to have set off a virtuous cycle of job gains, rising wealth, expanding consumer demand, and more hiring. After years of widening, the wealth gap was actually shrinking. And then the pandemic arrived. The depth and breadth of its economic disruption was greater than that of any post-war recession. About 40% of those who earned less than $40,000 a year lost their jobs in March. New weekly jobless claims, which had hovered above 200,000 mark for months, soared past 6 million. The distribution of job losses was completely different from what one usually sees in downturns. Low-income Americans were hardest hit, the hardest hit group in terms of both the general economic impact of government shutdowns and reduced spending on face-to-face services. Broadly speaking, this was the first service sector-led recession, as well as a big city recession, and interestingly enough, a woman's recession. And some may say, why a woman's recession? It just so happens in our country, often women are the primary caregivers for children, and with schools being shut down, many women were not able to continue to work. Remarkably, the unprecedented challenges of the pandemic spurred on-the-fly innovations. Americans are great with innovations. Access to telemedicine expanded. A company called Zoom, which few had heard of before the pandemic, became an instant global brand. Manufacturers repurposed assembly lines to make ventilators and masks. Congress took a rare break from partisan battles to approve the largest stimulus package ever passed. Millions of Americans received $1,200 stimulus checks, no questions asked. The Paycheck Protection Program kept many small businesses afloat while providing a windfall for others. Expanded unemployment benefits helped the jobless get by and sustained spending. As a result, household incomes and expenditures, grossly defined, were surprisingly resilient. But then another shock took place. On May 25th in Minneapolis, a Black man named George Floyd died while being arrested by police, one of whom was later charged with second-degree murder. As a cell phone video of Mr. Floyd's death began to circulate, protests and civil unrest spread across the country. Shopping districts that had just begun to open after COVID-19 lockdowns now boarded up their storefronts. In some cities, curfews were imposed. Meanwhile, the stock market recovered quickly. A tale of two cities, two worlds. And the labor market's recovery beat expectations. By November, unemployment had fallen to 6.7% from the disastrous 14.7% in April. The third shock came as no surprise, but was difficult to bear nonetheless: the contentious elections. Rather than a blue wave or a red wave, the American people produced a mixed election result, with Democrats winning the presidency but shrinking their margin in the House. Control of the Senate was ultimately resolved in January runoff elections in Georgia, with Democrat Kamala Harris empowered to cast the deciding tie-breaking votes in the Senate. Some say that divided government is associated with stability. We'll see. In summary, considering the magnitude of these three shocks, the market moves were remarkable. The Dow Jones closed 2019 up 27.8%, and it closed the year 2020 up an additional 7.2%. The broader S&P 500 for 2019 was up 28.9% and ended up closing the year 2020 up 16.3%. The tech-dominated NASDAQ in 2019 was up 35.2% and closed 2020 up 43.6%. The 2019 closing yield on the one-year Treasury decreased by 100 basis points, and for the year of 2020, it decreased by an additional 152 basis points, closing the year with a one-year yield of 0.105%. The 10-year Treasury in 2019 decreased by 77 basis points, closing the year at 1.91%, and by the end of 2020, closed the year at 0.913%, or a decrease of an additional 100 basis points. Remarkable moves in all of the markets. As 2021 begins, stock investors are heading into the new year with a U.S. economy that may be primed for recovery, growth, and continued adaptation to a new normal. Some industries will continue to suffer as long as the pandemic lasts and beyond. Commercial real estate companies and bricks and mortar retailers are reinventing themselves for a new work from home, shop from home age. Startups are blossoming. The financial sector is solid. An online economy hardened thanks to recent surges in broadband infrastructure kept America running through the dark days of 2020 and will likely expand further. And fortunately, highly effective vaccines are starting to become available. So the question for this year is, when it is safe for business to resume as usual, will the economy take off? Americans have accumulated over $2 trillion in new savings deposits since February, according to the Federal Reserve. This is more than 10% of GDP waiting to be spent. And it's likely that more stimulus is on the way from Congress. Now let's examine in greater detail the financial data and predictions for the year ended December 31st, 2020. As we discussed earlier, the Dow for the year 2020 increased by 7.2%. We took a poll of the Westwood Village Rotary Club last year, and the club felt that the Dow would increase by 10%. And in addition, our financial advisors prognosticated on the Dow last year, and they felt that the Dow would go up 7.1%. By my calculations, the investment advisors nailed that almost on the dot. So that's 1 point for the investment advisors. For the S&P 500, it increased by 16.3% last year. The club felt that it would increase by 15%. It was very close. Well done. And the investment advisors felt that it would only go up by 9.1%. So I'd say that's 1 point for the club. Good work on the S&P 500. The NASDAQ finished the year up 43.6%. The club had a very conservative, there's a phone. It's a busy day. The NASDAQ increased 43.6%. The club felt that the NASDAQ would increase by 10%, and the investment advisors felt that the NASDAQ would go up by 11%. That's pretty much a push, so no points awarded to either the club or the investment advisors on that. With respect to the one-year Treasury, the one-year Treasury for the 12 months ended in 2020 decreased by 152 basis points to 0.105%. The club felt that the one-year Treasury would go up by 50 basis points, and our advisors last year felt that the one-year Treasury would close at 1.2%, or a decrease of 42 basis points. And so the investment advisors were a little closer on that one, and they got the direction right. And with respect to the 10-year Treasury, it decreased by 100 basis points to 0.913%. The club felt that rate would go up by 50 basis points, and the investment advisors thought it would go down by 12 basis points. So again, the investment advisors had the direction right, but they weren't anywhere close to the magnitude of the movement. Remarkable year. Also, as you may remember, in March, we actually did Investment Advisors Day on March 4th, which we were starting to crack from the pandemic at that time. But in March of 2020, our investment advisors carefully selected a portfolio of ESG stocks, including NVIDIA, Salesforce.com, the Vanguard Social Index Fund, MasterCard, Garden Health, and 2 positions in Microsoft. And if you had invested $10,000 in each of the positions recommended last year, Your portfolio at year end would have been $98,888, or a gain of $28,900 for the year, a 41% gain, not annualized, and that's before dividend income. What will happen in 2021? Again, we have assembled a distinguished panel of experts from the ranks of the Westwood Village Rotary Club. But before inviting our investment advisors to prognosticate, it's time to poll the Westwood Village Rotary Club. And President Nancy, would you help us with this polling?
Absolutely.
If you could, I'm going to ask everyone to respond by raising their hand on Zoom, and I'm going to ask President Nancy to officially total or give the consensus, really, of the feeling of the Westwood Village Rotary Club. First of all, with respect to the Dow, how many people feel the Dow will be lower for the year 2021 than it was at the beginning of the year? And at the beginning of the year, it was at 3606. Today, it may be 700 or 800. I don't know where it is for sure. Maybe 700. How many think it will be lower?
So we have one vote for lower. Oh, two. I'm sorry. Two votes for lower. Three. Going once. Going to 3 votes for lower.
How many think it'll be higher?
Let's see. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14.
Kurt's cat is non-responsive.
I think the consensus is with the higher, President Nancy.
I think so.
Okay. How many people think it will be higher by 5% or less? Higher by 10% or less?
Oh, and I'm sorry, Steve, I didn't catch all those hands. Less than 5%. 1, 2, 3. Okay. Got it?
10% or less?
1, 2, 3, 4, 5. Okay.
And then 15% or less?
Oops. 1, 2, 3, 4. Okay.
And greater than 15%? There's like Chris Gaynor over there.
Okay. I'm only seeing one for more than 15%.
So, President Nancy, the consensus, I would say, is between the lower range of 10 to 15%. Would you agree with that?
Yes.
So 12.5% maybe?
Yes, and I will send these to you.
Good, thank you. Let's go to the S&P 500 now. S&P 500 closed the year at 3767. How many people believe it will be lower than that at the end of the year?
1, okay.
These CPAs are impossible. How many believe it will be higher? Okay.
1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. I would say it looks like 15.
It looks like higher. So higher by 5% or less.
1, 2, 3, 4. Okay.
Higher by 10% or less. Higher by 15% or less.
Wait, I'm sorry, I'm still counting. 15%. Okay. 15% or less. Oh, I forgot to vote. 1, 2, 3, 4, 5. Okay.
And greater than 15%.
All right. I like optimistic thinkers. 1. Okay.
So what's the consensus on the fly here, Nancy? What do you think?
Well, it's similar as with the Dow. The majority voted for either up to 10% or up to 15%. So I think if you want to say roughly 12.5, that's probably about right.
Sounds good to me.
About the same.
And then with the NASDAQ, the tech-heavy NASDAQ, more growth stocks probably in the NASDAQ. How many believe that the NASDAQ will be lower than it started the year? And it started the year at 12,888. How many believe it will be higher?
1, 2.
Higher. So I think higher is probably where we're going there. And higher by 5% or less.
2, 3. Okay.
And higher by 10% or less.
1, 2, 3. Okay.
And higher by 15% or less.
1, 2, 3, 4. Okay.
And greater than 15%. Well, there's a CPA.
Two brave ones. Yeah. Okay. Positive thinkers.
What's our consensus, President Nancy?
Once again, it's the same range.
Got it. Okay.
Which is interesting because, to your point, the NASDAQ is made up of much more predominantly growth-oriented companies, but.
So let's go to the 1-year Treasury. And the 1-year Treasury started the year at 0.105%. How many believe that the interest rate on the 1-year Treasury will be higher at the end of this year than that?
1, 2, 3, 4, 5, 6. Okay.
How many believe it will be lower? Okay.
1, 2. Okay.
And so I think the hires have it, Nancy.
Yes.
How many believe it will be higher by 25 basis points or less?
1, 2. Steve, forgive me, but I know that not everybody in the club is a financial expert, so not everybody knows what a basis point is.
So the difference between a 1% interest rate and a 2% interest rate would be 100 basis points.
So for the sake of everyone who's voting, 25 basis points means 1/4%.
Right. So 25 basis points or lower increase. 50 basis points or lower increase. 75 basis points or lower increase. And greater than 75 basis points. That's on the 1-year Treasury. So it looks like we've got a bias towards the upside, and maybe somewhere around 50 basis points. I don't know, Nancy, what does your on the fly look like there?
Interestingly enough, they're very close. 3 voted for 50 basis points and 4 voted for 75 basis.
Got it. Okay. And then the 1-year treasury. This is the fascinating one, I think.
I'm sorry, you mean the 10-year treasury, Steve?
10-year treasury now. And the 10-year treasury, how many believe that the yield on the 10-year treasury will be lower than it began the year at 0.93%? In other words, it was lower than 1% at the beginning of the year. None. So I think higher has got it. And how many believe it will be higher by 25 basis points, a quarter of a point or less?
1, 2, 3, 4. Okay.
And 50 basis, greater by 50 basis points
1, 2,
or less.
3, 4. Okay.
And 75 basis points or less.
1. Okay.
And greater than 75.
No one is that optimistic.
I thought Richard Thompson. Yeah, Richard.
Oh, Richard, I'm sorry, I didn't see your hand. I apologize, Richard.
Well, there you go.
Oh, Dwight too? Okay, also that's 2. Okay.
And if you'll send me those, I'll make sure they get into our statistics for next year, Nancy. Thank you.
Absolutely.
Thank you. So now, for the moment you've been waiting for, our financial advisors are going to opine on the 12/31/21 close for the Dow, the S&P 500, the NASDAQ, the yield on the 1-year treasury and on the 10-year treasury. This year, we've all decided to pick a Biden stock as part of our portfolio. And everyone will talk a little bit about how they see the world unfolding from an investment standpoint. To go first today, are you ready to roll, John O'Keefe? And before John begins, I see he's unmuting. John is probably one of the most successful money managers in the state of California, and he over the years he's represented some of the most important investors within the state and beyond, and he's a man who knows what he's talking about. Take it away, John.
Thank you. Boy, oh boy. I got a lot to fulfill for that. I don't know where that all came from. But anyway, I'm going to start out my typical fashion discussing the futility of forecasting. And I have to use this quote every year. You guys are going to get tired of hearing this from Mark Twain, saying forecasting is a very difficult art, especially about the future. So anyway, Steve gave us a lot of statistics. And of course, at the end of last year, most of us didn't think 2019, the S&P was up 32%. None of us thought we could get anywhere near that. And quite frankly, we were a little bit right about that because it was only up a measly 18%. I added in dividends, Steve. That's why my number.
Oh, that's good. Thank you for doing
dividend. It was up only a measly 18%. But you know, that ain't that bad. 32% in 19 and 18% in 20. You could make a lot of money if it keeps going like that, couldn't you?
Indeed.
But we made a number of other forecasts, or some of us made a number of other forecasts, or the market did also. If Trump loses, the market's going to go in the tank. Well, Trump arguably lost in November. Some people don't think he lost until January, but he lost in November. And believe it or not, guys, November of 2020, just that month alone, the S&P was up 12.8% in just that 1 month. Just that 1 month, mind you. Okay, another forecast we've all been making lately. Value is finally going to take over from growth. And guess what? Last year, the S&P 500, which is basically a growth index, was up about 18% with dividends. And the Vanguard Value Index was up a measly 2.3%. So value still hasn't taken over from growth yet. And then the other thing we talked about is international stocks were cheap in 2020 starting the year, and they're going to start doing better than U.S. stocks. Well, guess what? The U.S. market, the S&P was up 18%. International stocks were up 10%. So that didn't work either. So back to my thought again, futility of forecasting. Let's talk a little bit about, this is one of my most important points about the market. If you're going to be in the stock market, you got to be invested and you got to stay invested.
Amen.
It's very futile to try to trade it. And I'm going to go back to November of 2020 again. The S&P was up 12.8% that 1 month. If it took that month out of the year, guess what the S&P was up last year? Take away November, the S&P was up 2.8%. So if you were invested in the market and didn't happen to not be in November, you would have made peanuts last year, you know. And by the way, the last 5 years, the S&P has been up 15% per year in the last 5 years. So if you were in the market all that time, you would have doubled your money in those 5 years. 15% a year for 5 years, you doubled your money. How about this idea of unified government now? We have the president and the Senate and the House are all Democrat. Is that good or bad? Well, I went back and looked at some statistics since 1933 through 2019 with a unified government. In other words, the same party in all three fashions of government, the market averaged 10% a year. So it hasn't done bad in a unified government. And number next, we realize that the Fed is definitely committed to low interest rates. They've stated as far out probably as 2023, and their goal is near zero on Fed funds. So it's hard to imagine that interest rates can go very, very high with that kind of forecast. Now I'm going to look at 2021. I think we're going to have a continuation of the good market we've had, not as good as we've had in the past couple of years, but still a good market. And I do think that growth is going to continue to trump, if I can use that word, continue to trump value. And the U.S. stocks are going to continue to top international stocks. But we're getting closer there, I think, because the U.S. dollar is starting to weaken now, and that will help international stocks. Here are my picks for the year. The S&P 500 at 10% plus. The Dow Jones 8% plus. The NASDAQ 10% plus. The 1-year Treasury closed the year at about 9 basis points. Closed this year at 20 basis points. That's quite an increase on 10 basis points. The 10-year Treasury closed the year about 99 basis points. It'll close this year at 1.2%, a little higher there. My Biden stock, we're to choose a Biden stock. Steve has charged us all to choose a Biden stock that will benefit in the Biden presidency. And I chose Johnson & Johnson. I think there's a big push from Washington, both the Congress and the presidency, to get everyone vaccinated as soon as possible. And that's great. Get the U.S. safe and healthy. Johnson & Johnson has got a vaccine which is near getting approved. They're estimating maybe March. And one benefit with the Johnson & Johnson vaccine, it's a one-shot vaccine, whereas the Moderna and the Pfizer are 2 shots. A one-shot vaccine, which is going to do very well, and Johnson & Johnson is able and will produce a lot of this vaccine. The stock is at 18 times PE, which is very cheap for Johnson & Johnson, a 4% yield, which is attractive, and it was only up 6.5% last year. So it's due to make up some of that. And listen, guys, all in all, forecasting is fun, even though it's impossible. That's me.
Thank you, John, for an excellent report. And it's especially fun when you're doing the prognosticating.
I'm always going to be wrong, though. You know that?
I don't know. Jim Crane. Jim Crane is a financial advisor at New York Life. And over the years, as he's participated in this Investment Advisors Day, has been prescient in divining the exact way that markets will unfold. And so, Jim, we're ready for your prognostications.
Hey, it's interesting. I sort of agree with John that my Biden stock is United Health Group, and I avoided the marijuana stocks and the all of the alternative energy stocks and all those. But United Health Group is the largest private health insurance provider in the United States, offering medical benefits to nearly 50 million members across the U.S. and international businesses. It could really do well if the Biden administration is able to implement the Medicare-like government option for health plans to make private sector plans more affordable and less complex, as he touted all the way back into the primaries. It could potentially put in an additional 23 million more insured Americans than are on the insurance rolls today. So the other thing is United Health specializes in Medicare supplement policies, and they are sort of a leader in that particular area. I have to admit that being a insurance agent, I do have one small client in the Long Beach area that does have a United Healthcare policy, so I'm a little bit familiar with them. As far as the one-year U.S. Treasury, I don't see it really changing from where it is today. It just is very low. I don't see it growing. I put it down as 0.1%. The Fed, as John mentioned, the Fed policy really isn't changing. In fact, they're going to wait until even if there's some form of inflation before they start to change things. The 10-year U.S. Treasury, I think it's going to go to 1.5%. So there is an increase there, maybe as much as somewhere around 50 basis points. It really went down low during the year 2020, and so I think it could move up a little bit. The Dow Jones Industrial Index, I said about 10% higher at the end of the year, somewhere around 33,450. I think the S&P 500 could go up a little bit higher. I put down 12%. I think the Dow and the S&P 500, it's probably going to be either very high single digits or relatively low double digits. So I tend to be a little more, I guess, bullish on it. So I put it in as sort of the low double digits. And in terms of the NASDAQ, I think it's going to do even better. So I put down 15%, somewhere around 14,800 at the end of the year. I would just go back to the Biden stock and say, I think John's got a good idea with Johnson & Johnson. United Health Group is such a massive company in the insurance business. The last 5 years they've had an average annual return of 26% per year, so they've done very well. And like I said, they have the opportunity, if Biden is able to push through his Medicare-like government option, why things could really boom in 2021. Anyway, Steve, that's my forecast.
Thanks
Can I
again.
interject? Oh, that was great. Thank you, Jim. I just want to interject very quickly. We'll probably go past 1:30, and I know that there will be lots of questions. So I just want to invite anybody who actually needs to leave at 1:30 to do so. I personally am going to stick around, and I suspect most of you will too. Sorry, Steve, and thank you, Jim.
Thank you, Jim, for your insights again, your excellent insights. Our next speaker is Dwight Hakela. And Dwight is a certified financial planner and is a money manager, and again, a person who has great insights into the unfolding of our markets. And Dwight, you're on.
You're on.
Can you hear me?
Yes.
Now?
Yes.
Okay, great. Okay, well, most of my thunder has been stolen, but I have a few things to say. I think that it'll be a choppy year all through the year. We're going to have some unpleasant surprises about the virus, but we will make progress. As far as predicting the S&P, I think it'll go up about 11.5%. The Dow only about 8%. So growth will dominate value again. The NASDAQ will be up about 16%, perhaps even more. The interest rates, I'm not sanguine about, optimistic. 1-year Treasury, I think, is going to go all the way up to 0.4%. And the 10-year is going to go to 2%. So we're going to be in trouble paying our interest on our national debt. But that's can't be helped because the Fed cannot control the 10-year. If people are not willing to accept a 1% or 1.5% yield, and if Treasury has to float that bond, they're going to have to accept paying 2%. So I don't want to see that happen. That's one thing that'll hold the recovery down a bit, certainly. My stock would be Logitech. Mm-hmm. That's been around about 20 years. That's a peripheral company. It doesn't make anything fancy. But more and more people are getting on the internet now and will continue to do so. So that's my pick and shovels internet stock. I actually understand what they make, like a mouse. But last year, my NVIDIA was up 133%, and I don't understand one damn thing about the company. So it really doesn't matter, like John said. That's pretty much it.
Well, thank you, Dwight. And NVIDIA was a home run.
Yes, it was.
Great work. Nancy, would you like to present your prognostications?
I would like you to do it so I can watch everybody.
Okay, I would be pleased to do that. Nancy is, her Biden stock is Clean Energy Fuels Corp., which is an excellent company. Its symbol is CLNE. Nancy's prediction for the 1-year Treasury rate is at 0.18. On the 10-year Treasury, it's 1.50. For the Dow, it's 32,599. For the S&P 500, it's 4,200. And for the NASDAQ, it's 16,000. And is there anything you'd like to add to that, Nancy? I thank you so much for helping us.
Oh, my pleasure. And I think that my colleagues on this panel and you have done such a marvelous job. I don't feel the need to elaborate further.
Very good. And so then for my predictions, I I echo the rhythm, the rhyming of that others who have preceded me have indicated, and so I think the Dow will be up maybe 7.5%. The S&P up maybe 12.5%, and the Nasdaq up around 17.5%, skewing more to that NAS. I think all this money that's coming into the system is going to be looking for a home, and so I think there'll be a lot of stimulation for the equity markets. Although, as Dwight says, there can be some choppiness, and who knows how long it's going to take for everyone to get vaccinated. And ultimately, that's one of the keys to success of the markets. If it looks like the vaccinations aren't going to make it, or not enough people are getting vaccinated, I think the market could have a very tough time. But I think it's likely that it's going to unfold in such a way that there is a light at the end of the tunnel. And so that's my general view. Again, with the Fed taking the posture that it's taken, at least for this year, with that pressure for short-term rates to stay as low as they are, and the Fed to be as accommodative, it's a very favorable situation. The problem, of course, which none of us have really focused on because we're focusing on just this year, is what this may do to the economy 2, 3, 4 years down the road, and the amount of debt, the potential for inflation, the potential for interest rates to rise significantly at some point in the future. Those potentials are out there. And so I think for all of us, we're probably watching to see how that unfolds over the next 2 or 3 years. The stock that I would like to offer is a stock that's been a favorite of mine on and off for many years, and that's Qualcomm. And Qualcomm offers the route to 5G, and 5G and that part of the infrastructure is so important for all parts of our economy right now. And Qualcomm owns much of the intellectual property that allows the 5G, the decrease in latency that you notice when you have internet communications, and they enable that decrease in latency. And that decrease in latency it's in automobiles and refrigerators and you name it, wherever it goes. I think that the impact of 5G through Qualcomm is an important thing for us to think about from an investment standpoint. By the way, you get a great yield if at the current levels. The yield is over 1.5%. In fact, I think it's about 1.7 or 1.75%. So it's a great yield while you're holding it. So those are my predictions for the year. And at this point, I'd like to open the floor for any questions that someone might have.
I see Kurt had his hand up.
Kurt? Okay, Kurt, go ahead. What's your question?
He's muted.
That I was just stretching. I wasn't raising my hand.
Oh, sorry. Phil? Oh, I'm sorry. Tom was next. Phil and then Tom.
Tom Barron. What's your question, Tom?
Yes. I think Biden's no more than a tool and a puppet for the far left. And the far left has already indicated he's following the far left. The far left is going to lead us to, obviously, abandoning the pipeline, going to lead to unemployment, etc. What significance do you think they'll have on a less economy, or hurting the economy and eventually inflation and higher interest rates?
John, do you want to take that question?
Well, I'm not sure I agree with Tom about Biden being that far left. I think he's a middle of the road guy, and we certainly have planted the seeds for inflation with all the deficits we're running here, and they're going to come back to haunt us at some point in time that Steve was talking about. But I think we're okay for the time being, and I'm optimistic that Biden is going to stay middle of the road and get a lot accomplished with Congress, I hope.
Have you been reading his executive orders this week?
No, I've read a few.
Well, I've read some.
Well, he has to do something to take care of those terrible ones that Trump left us with. But I
Yes,
don't know.
exactly. Exactly.
Methinks that Tom is making a statement rather than asking a question at this point in time, which is okay. That's fair.
Yeah.
I have a question.
Bill, go ahead.
Besides United Health, Logitech, CLNE, and QCOM, if someone has $10,000 they want to invest for the next year and a half, 2 years, anybody else has any other companies that they like?
Well, other than GameStop,
Yeah.
Yeah.
Dwight, would you like to take that one?
You could just buy some cues. You can buy some hot company and you have all the story about it. And you're all wrapped up in it and enthusiastic. And then at the end of the year, the damn thing is down 5%. Buy the cues. If anything's enthusiastic, if anything is going to be higher, it'll be the QQQ, and it's cheap.
What is that? What is QQQ?
That's the NASDAQ.
Oh.
It's an ETF. Costs almost nothing.
He's saying the index.
I would recommend the S&P 500 index myself.
Marcia, you have your hand up, and then Mark.
I was wondering what they thought the ecological car, like Tesla and stuff, how they're going to do.
Good question. Jim, would you like to take that question?
Tesla is one of the ones that could do really well next year. So I mean this year. So that's along with all the others you heard. There's nothing wrong with it. It's in line with Biden's sort of plan for energy, and so yeah, it's good.
Thank you.
Mark, you have a question?
Mark Rogo has a question.
I'm just curious, Steve, what your panel thinks about anything in your portfolio that's a life insurance stock. This may be focused to Jim Crane, because we have over 400,000 Americans that have died this year that weren't planning on it. Not that you're ever planning on it, but an unusual spike in the statistic. And we all know that we're fast heading to 500,000. That's a lot of payouts on life insurance policies. So anyway, I'm just curious what people think on your panel about your holdings in life insurance companies.
Jim, you want to take that one? That's right up across your strike zone here.
Yeah, let me say something. Mark, I think one of the things that the life insurance company started doing is they started slowing down on offering policies to older people.
Hey, Dad.
It's really interesting. New York Life is discontinuing something called Value Whole Life. It's cost effective for individuals that are aged 50 and plus on Sunday. So, and we were one of the last ones. I think there was a lot of companies that they just stopped underwriting anybody that was more than like 75 years old or something. I mean, and this has been months ago, actually. The other thing is the interest rates are so low that some of these life insurance companies, well, I think all of them, have a problem with their investments. I mean, typically 90% of their investments are in like the equivalent of 10-year treasuries. And so you can imagine what happened. And I think it was like 2 days ago, Allstate announced that they're getting out of the life insurance business. They sold some of they're focusing more on property and casualty going forward. So I think it's really impacting some of the companies, but they're making shifts, and their claims that they're going to be able to pay out the death benefits that are due. It's just that they're looking forward and they're they're basically pulling back on insuring older individuals.
Great answer, Jim. Great answer. Chris Gaynor. Chris Gaynor.
Yeah, Steve, this call is for you.
Got it. Go.
What are you telling your clients about their mix of their portfolios? You know, many years ago, people at 65 to 70 were not considered to live for a lengthy period of time. Now, all of a sudden, people are living into their 90s, and it's not unusual to have people in their late 60s and early 70s to have parents that are still alive. So with that in mind, a conservative portfolio may not keep them with all the options that they require. So I'm curious, what are you telling your clients on, someone who's 70 that may live to 95 or even 100? What type of mix are you suggesting?
So, Chris, this is a great question. And this falls into the category that in investment parlance is called risk mitigation. And what do you do to mitigate risk in a portfolio? And years ago, the answer to that question was really clear. When interest rates were as high as they were, you had a mix of bonds and stocks. And the idea was, well, you get some growth from stocks and you get some dividends. And then, of course, the stocks can go up and down, and that could be a problem. So to hedge that, to mitigate the risk of your varying return in stocks, you bought bonds, and of course the bonds had a good yield. Now, when you think about it, about the only way to totally mitigate risk is to be in, at least my view, is to be in a short-term treasury if you don't want any risk. Because if you're in bonds, the chances are, especially long-term bonds or even medium-term bonds, you're going to find rates going up and you're going to lose capital. So if you're in a short-term treasury, you're not going to lose any money, at least. And so if you're rich enough that it doesn't matter if you get less than 0.1% of yield, then I suppose you can be in the one-year treasury and mitigate risk that way. Most people don't find themselves in that kind of a situation. And so to mitigate risk, you end up going into dividend-paying stocks, and dividend-paying stocks that don't have the volatility of maybe some growth stocks, although some growth stocks might be a good place to be to mitigate risk. You need to be able to select the right stocks that are going to at least stay the course, stay in business, and stay productive. Sometimes people look for dividend. One of the most interesting risk mitigation investments in the stock market, it might be a company like a Verizon, where you got a big yield and you've got a chance to participate in some way in a little bit of growth over time. So the days, at least in the advice that we're giving to our clients, where we have a 60-40 combination of bonds and stocks, we're not doing that anymore. We do, for some clients, have bond portfolios, but generally speaking, not as big a percentage of the portfolio as it was before. And in addition, we look for stocks that have stable dividends and dividends that increase over time. Does that respond to your question, Chris?
I would like to add a few more comments to it, and that is, if someone is 70 and you anticipate they're going to live to 95, how do you overcome inflation? And they have to have at least a 5 or 6% annual increase, to pull money out and to stay current. It seems to me that they have to be in the market. And I know that there's a risk element in there. And I think the government has been forcing seniors to be in the market just because fixed rates are so low. And, it's not as if someone at 70 is going to be checking out at 75, especially when you have the history of the families.
So I'll take one more shot, and then somebody else may want to jump in. But one of the things that I believe is I don't believe interest rates are going to be low forever. I think there will come a time when rates go back up. And so maybe you start to look at this in 3-4 year chunks of time. And so you may have a strategy for the next 3 or 4 years that is flexible enough so you can change it for this person who's 70 now. They can change the strategy when they're 74, 75. Chris, anybody else want to jump into this? Is an excellent question, a really practical question. Anybody else want to weigh in?
I think what you said earlier, Steve, about dividend stocks, you can find a whole lot of stocks nowadays of good companies that are yielding 3% or more. And they might be put in the category now of value stocks. And you may miss out on the performance of value vis-a-vis growth, but that's okay. I think these companies, many of them, there's a group of them called the dividend aristocrats, I think. And there's about 50 of them that have increased their dividend every year for, I mean, the last 10 or 20 or 30 years. Those kind of companies are good. You may not be able to brag about your performance at a cocktail party, but you're going to get a steady income from dividends that you can pretty much depend on, I think. That's kind of how I think about it for myself anyway.
Excellent point. Dwight, I saw you were waving your hand. Did you want to weigh in?
Yeah, I've been watching the growth value bifurcated market for several years. The first half of this year, just like last year, 2020, I'm talking about 2020, 2019 and 2020 first half, growth outperformed value by about 30%. If you look at whatever you want to take as your proxies, I use SPYG and SPYV. Huge amount. From July 1st to the end of the year, growth outperformed value by 2%. So that's a pretty big change from a 30% edge to a 2% edge. So it is moving. It's an inflection point. Could it go back to growth? Yeah, I still think the NASDAQ's probably going to outperform because there's something about growth that the scientists haven't figured out yet. But it's on an inflection area. So I like these guys talking about dividend stocks. Now, the dividend funds last year, I know the S&P high dividend fund is doing nothing. Been doing nothing for 2 or 3 years, but it's got to come back. And we're talking about 20, 25 year horizon. It could come back with a vengeance. And over the very, very long term, as you know, value has outperformed growth by a small amount.
That's true. That's true.
Jim Crane, do you want to jump in on this risk mitigation issue?
I would just say 2 things, and maybe these are short run things when interest rates are rising. One would be the bank loan stocks, mutual funds, where the loans are like 90-day loans or they're really short. So that's good when things are rising. The other would be mutual funds of convertible bonds. So if things get really well, you convert it into the stocks. So those are two ideas when interest rates are rising.
Are there any other questions that we can take now? Thank you all for your excellent questions, and I'd like to especially thank our panel today for their outstanding participation again. And the only piece of advice that we all agree on is that everyone should strive to buy low and sell high.
Amen. Thank you, Steve.
And thank you, Steve, for once again doing a wonderful job of moderating.
Great panel.
In the last couple of months, you've led 2 excellent panels. So thank you. We'll see you all next week. We meet again next Thursday. We're into February 4th. So have a great, safe, and healthy week. And we'll see everybody then.
Bye-bye.
Goodbye.
Bye, guys. Bye-bye.